You might think the silver market is calm, boring even, while the price drifts on your screen. But behind the scenes, something enormous just happened, something that the mainstream media isn't telling you. In the past few days, roughly $42 billion in silver exposure quietly moved off the books. Not by small investors, not by retail traders waking up to headlines. This was a massive, coordinated offloading by institutions. And it happened without anyone noticing, until now. The timing was perfect. Thin liquidity, end-of-year trading, and sleepy markets that couldn't absorb such a move without disruption. On paper, it looks like nothing changed. Prices barely blinked. But in reality, the structure of the market has shifted fundamentally. Tens of billions in leveraged positions, previously floating as paper risk, are now gone, leaving a cleaner but far more fragile system behind. And here's the kicker. This isn't a bearish event. It is the kind of move that sets the stage for a violent divergence between paper silver and the physical market, creating scarcity, premiums, and opportunities that only those paying attention will see. What happened is invisible to most, but its consequences are about to be unavoidable. The question is, are you ready to see what the market is really telling you? To understand what just happened, you need to see behind the curtain. The $42 billion in silver exposure that quietly moved off the books didn't just vanish. It was shifted with precision through a combination of over-the-counter trades, derivative settlements, and large-scale offloading that never touched the open market. These are not the trades you see on your screen, the ones that make headlines or flash red on broker apps. This is the shadow world of institutional finance, where positions are hedged, leveraged, and most importantly, moved without anyone realizing the magnitude of the shift until it's already done. Think about it. $42 billion is not a number you move casually. It's the kind of exposure that, if handled carelessly, could trigger cascading liquidations and wipe out markets in minutes. Yet, it happened almost invisibly. While retail investors were asleep, ETFs remained calm and most mainstream outlets were still talking about minor volatility as if nothing had changed. Here's how it works. Institutions with massive positions in silver often don't hold it physically. Instead, they operate in paper markets, futures contracts, swaps, and options. These instruments allow them to control huge amounts of exposure with a fraction of the capital, but they also create enormous systemic risk. When a player wants to reduce risk, whether for regulatory reasons, margin relief, or portfolio rebalancing, they don't dump contracts onto the open market. That would spike volatility and destroy value for themselves. Instead, the exposure is moved through internal books, OTC agreements, and block trades that quietly transfer positions to counterparties or hedge funds willing to absorb them. It's like moving a giant ship through a canal without disturbing the water level. Everything shifts, but no one outside the system notices until the wake hits downstream. Now, consider the timing. These moves don't happen during regular market hours when liquidity is high and algos are monitoring every tick. They happen during off hours, thin liquidity periods, or even during holiday sessions, when the market is technically open but virtually empty. That's exactly why this $42 billion move was so clever and so consequential. By shifting exposure when the market is quiet, institutions avoid triggering a chain reaction of forced liquidations, negative gamma feedback loops, or margin calls that could cascade through other leveraged players. But while the immediate chaos is avoided, the long-term effect is profound. The paper market is now lighter, but the underlying risk has been reallocated, leaving gaps between paper contracts and physical silver that few are watching. This is where the disconnect between the paper market and the physical market becomes critical. On your screen, the price might not show dramatic movement. A few dollars up or down, maybe a small increase in volume. But in reality, every contract that was quietly moved off the books represents real physical risk and scarcity that the system no longer manages. Vault inventories in COMEX, LBMA, and other major hubs are beginning to reflect this shift. Premiums in Asia, particularly in Shanghai and Singapore, have started creeping higher. Delivery times for physical silver are stretching. The paper market looks stable, but the physical market is tightening. And that's the invisible pressure that will eventually force the paper and physical prices to converge violently, if history is any guide. Let's be clear, this isn't about panic selling. Retail investors didn't trigger this. ETFs didn't spike. This was a strategic, calculated move designed to reduce systemic risk and reallocate exposure before the next big market event. It's a silent cleanup, a preemptive adjustment that insiders make while everyone else is distracted by headlines, minor fluctuations, or technical charts. And yet, it creates the conditions for a potential future shock. Because while the $42 billion has moved off the books, it hasn't gone away. It has been redistributed. Somewhere, someone is now carrying that exposure, possibly with less capital, more leverage, or greater vulnerability to liquidity stress. The system is cleaner, yes, but also more fragile, like a forest after controlled burns. Appears calm, but still contains tinder for the next blaze. To really appreciate the scale of this move, you need to understand the leverage involved. In silver markets, paper contracts often exceed physical supply by hundreds of percent. A single large liquidation or offloading can ripple through prices, triggering margin calls, forced sales, and cascading liquidations. The $42 billion shift removed a massive amount of risk from the books, reducing the chance of a sudden snap, but it didn't eliminate it. The remaining leveraged positions are now more exposed to any unexpected liquidity shock. That's why the market watching the price on your screen might seem stable, but in reality, the system is still carrying enormous hidden stress. And here's the kicker. The effect on global premiums cannot be overstated. As exposure moves off the books in the West, physical demand in Asia continues unabated. Vault withdrawals, industrial purchases, and hoarding behaviors continue to push the physical market tighter. This creates a growing disconnect. Paper contracts in New York or London may remain steady, but actual silver is being absorbed elsewhere, and the premiums that reflect scarcity are rising. When the paper market eventually tries to realign with the physical market, the movement could be sudden, violent, and far beyond what casual investors expect. Those who are aware of this shift are in a position to anticipate it. Those who are not are likely to be blindsided. Finally, it's critical to recognize the strategic timing. Institutions didn't just move exposure, they did it when other market participants were least likely to react. While retail investors focus on daily charts and ETFs, the real shift in risk has already occurred. The $42 billion is gone from public books, leaving the market structurally different than it was yesterday. For those paying attention, this is a warning and an opportunity. It is proof that the market is not always what it seems. Stability on the screen can hide enormous structural change behind the scenes, and understanding these mechanics is the key to seeing the next big move before it arrives. In short, this $42 billion shift is not a story of panic. It is a story of leverage, control, and systemic foresight. It is the invisible hand reshaping the market quietly, methodically, and strategically. And while most investors are distracted, the real tension is building, a tension that will eventually reveal itself in price, premiums, and scarcity in ways that will be impossible to ignore. Those who understand how these moves are executed and the ripple effects they create are the ones who will see the opportunity long before the rest of the market even knows the shift has occurred. Now that we understand how $42 billion in exposure quietly moved off the books, it's time to look at what this really means for physical silver, the metal you can hold, stack, and rely on. Because while the paper market might appear calm, the physical market is telling a very different story, one that most investors are completely ignoring. This is where the true significance of the $42 billion move becomes impossible to overlook. Every contract that was shifted off the books represents not just risk being removed, but a real-world scarcity pressure building quietly in the background. While the paper market continues to trade in neat ticks and charts, vaults around the world are feeling the strain. Look at the data. COMEX inventories are dropping steadily. London and Singapore vaults are reporting slower delivery times and record withdrawals. Meanwhile, Asia, the real hub of physical silver demand, is absorbing metal at a pace the West cannot match. Premiums in Shanghai and Singapore are climbing, a silent indicator of scarcity, while Western paper prices remain deceptively flat. The disconnect is widening. On one side, the paper market is temporarily cleansed, leveraged positions reduced, and systemic risk moved away from the books. On the other side, actual silver is being hoarded, bought, and withdrawn, creating a supply-demand imbalance that will eventually assert itself violently if ignored. Here is the critical point. The $42 billion exposure move reduces immediate risk in the paper market, yes, but it does nothing to relieve pressure in the physical market. If anything, it exacerbates the tension. The metal isn't disappearing. It's being concentrated in strong hands, industrial buyers, and strategic reserves, primarily in Asia. This is why we seeing premiums rise even as prices in New York or London seem stagnant. The market is fractured. Paper and physical prices are no longer talking to each other. They are running in separate channels. And when the paper market eventually attempts to catch up with reality, the adjustment will be sharp, sudden, and unavoidable. Let's make this clear with an analogy. Imagine a river with two channels. One channel, the paper market, is wide, smooth, and engineered, flowing without turbulence. The other, the physical market, is narrow, crowded, and forcing water to move faster. The $42 billion shift removed a dam from the engineered channel, making it smoother and less prone to immediate flooding. But the narrow channel continues to surge, pressure building, water levels rising, waiting for the moment when the channels reconnect. That reconnection is the price discovery event no one is prepared for. When paper and physical converge, the movement won't be measured in small fluctuations. It could be seismic. This divergence is also visible in behavior. And while paper contracts have been quietly reallocated, physical silver withdrawals have accelerated. Large withdrawals from COMEX vaults, private storage, and ETFs show that buyers are taking metal out of the system, removing it from circulation. It's not speculation or panic, it's strategic accumulation. Industrial users, sovereign buyers, and high net worth investors know that paper prices are a shadow of true value. They are acting in the real market, taking delivery and leaving nothing behind for the casual investor who relies solely on charts. The $42 billion off-book move just created a perfect window for these buyers to act without creating chaos in the paper market. Yet the consequences for supply are now unavoidable. Another factor driving this divergence is the timing of global demand. While Western investors watch the screens, Asia is preparing for real-world industrial usage. Silver is essential for solar panels, electronics, medical applications, and even strategic reserves. Every ounce withdrawn from COMEX or London vaults is an ounce that may never return to paper contracts. And every ounce absorbed in Asia pushes premiums higher, widening the gap between the paper price and physical reality. That gap, already large, is now a signal screaming at the market. The next major move won't be caused by retail panic or technical charts. It will be caused by the physical scarcity the $42 billion move helped expose. Here's where the tension becomes clear. Paper markets are designed to absorb risk through leverage, hedging, and clearinghouse mechanisms. Physical markets, however, are unforgiving. They cannot be manufactured with a keyboard or algorithm. When exposure is removed from the books, systemic risk in the paper world is reduced, but the real-world supply-demand mismatch is intensified. This is why savvy investors are watching premiums, withdrawal patterns, and delivery times instead of relying solely on prices in New York or London. The signals are all there. They are just hidden from mainstream media and casual market observers. And finally, consider the implications for timing. The $42 billion shift didn't just happen. It was a preemptive structural adjustment, timed perfectly to avoid chaos in the paper market, while creating pressure in the physical market. For those watching carefully, the move is a warning. The market is preparing for a correction or perhaps a surge once paper prices and physical scarcity collide. The divergence between paper and physical silver is now extreme enough to create an explosive scenario where small triggers could lead to dramatic price discovery events. The question for investors isn't T whether this will matter. It S when and how it will manifest. In short, the $42 billion exposure move has fundamentally altered the silver landscape. Paper risk has been reduced, leverage has been cleaned, and the books look safer. But the physical market is tightening, premiums are rising, and scarcity signals are flashing red. The system now carries built-in tension between paper stability and real-world demand, a tension that will eventually be resolved in dramatic fashion. Those who understand this dynamic, the invisible pressure building between paper and physical silver, are in a position to anticipate the next move. Those who ignore it are relying on illusions, watching charts that no longer reflect reality, and risking being caught on the wrong side of history. With $42 billion in silver exposure quietly removed from the books and physical demand intensifying, the broader market is entering uncharted territory. Most investors are still focused on small price fluctuations and daily volatility, oblivious to the fact that the foundation of the market has shifted beneath them. This isn't just a story about one metal, it's about how leverage, liquidity, and global flows intersect to create tension that could ripple across commodities, futures markets, and even broader financial systems. The $42 billion move didn't just clean up institutional risk, it sent shockwaves into supply chains, premium structures, and global pricing, all while keeping the public unaware. Consider the mechanics of leverage. Silver, like gold and other commodities, is traded in a market where paper contracts vastly exceed physical supply. This system is designed to function under normal conditions, when liquidity is abundant and market participants are balanced between long and short positions. But remove $42 billion in exposure quietly, and the balance shifts. Suddenly, paper contracts no longer reflect actual supply risk, and those left in the market are either underexposed or forced to absorb positions they cannot comfortably hold. This sets the stage for sudden volatility the moment a trigger appears, a margin call, a delivery request, or an industrial surge in demand. Now factor in global dynamics. While Western markets focus on paper contracts and trading desks, Asia is operating on a completely different timeline. Industrial demand in China, India, and Southeast Asia is insatiable, particularly for technology, solar energy, and strategic reserves. The $42 billion exposure move in the West effectively freed up liquidity for insiders while leaving the physical supply vulnerable to these global buyers. This is why premiums in Shanghai and Singapore are climbing, even as prices in New York remain deceptively stable. Paper and physical are running on parallel tracks, creating a gap that can only widen until it reconciles. And when it does, the movement will be far more dramatic than the casual investor expects. This divergence also creates systemic consequences. Clearinghouses, brokers, and margin desks rely on predictable flows of contracts and collateral. When exposure is suddenly removed, the books may look cleaner, but the potential for stress remains high. Those remaining in leveraged positions may be fine for now, but they are exposed to liquidity shocks and forced selling if physical premiums continue rising. Imagine a tightly coiled spring. The $42 billion move released some tension, but it also concentrated remaining stress in areas that are invisible to most traders. A small trigger in this environment could produce outsized reactions. And it's not just financial mechanics at play, it's psychology. Investors and traders often rely on prices, charts, and media narratives to make decisions. Right now, the narrative is calm. Silver is stable, volatility is low, and the $42 billion move hasn't made headlines. But the real story, hidden in vault withdrawals, premiums, and global demand, is the exact opposite. The market is structurally stressed, and the disconnect between perception and reality is widening. The longer it goes unnoticed, the more dramatic the eventual correction or surge will be. Timing is also critical. Institutions carefully chose when to move this exposure. They acted during low liquidity periods, holidays, or off-market windows to avoid triggering panic. Retail investors and mainstream traders were largely asleep, oblivious to the shifts occurring beneath their screens. This strategic timing prevented immediate chaos, but it also concentrated risk elsewhere, in the physical market, in leveraged contracts that remain on the books, and in the growing gap between paper and physical silver prices. Those who understand these dynamics can anticipate the ripple effects. Those who don't are merely spectators waiting for the storm. The global implications extend beyond silver. Commodities, futures, and even the broader financial system are interconnected. A $42 billion move in silver exposure might seem isolated, but in a market built on leverage and cross-margining, the effects are contagious. Margin desks in metals, energy, and even currency futures are watching for volatility. An unexpected price shock in silver can cascade through correlated positions, forcing liquidations, triggering risk models, and creating a domino effect that spreads far beyond a single market. The $42 billion move has reduced immediate risk, but it has also set the conditions for amplified responses once other triggers align. Finally, there's the opportunity embedded in this chaos. The market's outward stability is an illusion. The real story is in physical scarcity, premiums, and global demand. Investors who understand the divergence between paper and physical silver now have a clear signal. The market is being quietly restructured, positions are being reallocated, and scarcity is building in a way that the paper price cannot reflect. For those willing to read the signals, vault withdrawals, Shanghai premiums, industrial buying, the stage is set for potentially dramatic upside once the paper market is forced to reconcile with reality. Timing and understanding will be everything. In short, the $42 billion move has done more than shift risk. It has redefined the market structure. Leverage has been reduced, liquidity shifted, and systemic exposure quietly redistributed. Meanwhile, physical silver continues to tighten, premiums rise, and the global flow of metal is creating pressure that cannot last forever. The calm on your screen is temporary. The tension building beneath the surface is not. The market has been altered structurally, globally, and psychologically, setting the stage for a moment when reality catches up to paper, and when it does, the consequences will be felt across every level of the system, from individual stackers to institutional giants. Now that we've seen how $42 billion in silver exposure quietly moved off the books, and how that shift has stressed the physical market while creating a widening gap with paper prices, the critical question becomes, what happens next? Because if you think the story ends with the cleanup, you're missing the real opportunity and the real danger. The truth is, the silver market has been structurally altered in ways that most investors will not understand until it's too late. The leverage is gone, the weak hands have been flushed, and the physical market is tighter than it has been in years. This is not a minor correction. This is the setup for a major divergence between perception and reality, a gap that could explode in one direction, up. First, let's look at the implications for pricing. Paper silver may continue to appear stable for now. Algorithms, futures desks, and ETFs have absorbed much of the shift, and volatility on your screen may seem muted. But this stability is misleading. Physical silver is being withdrawn, hoarded, and industrially consumed at a rate the paper market cannot reflect. Premiums in Shanghai, Singapore, and other Asian hubs continue to rise, signaling scarcity that is invisible to Western traders. The longer this divergence persists, the more violent the eventual convergence will be. When paper contracts are finally forced to align with physical reality, the price movement could be abrupt, large, and historically significant. Those who see it coming will benefit. Those who dismiss it will be caught off guard. Second, there's the psychological dynamic. Retail investors and casual traders are still being fed narratives designed to mask the truth. Mainstream outlets continue to downplay physical scarcity, tout calm prices, or spin volatility as minor corrections or retail panic. Don't fall for it. The $42 billion off-book shift, coupled with increasing physical withdrawals, tells a different story. The market is being quietly restructured while most participants are distracted. The The people who are winning in this environment are those who understand that paper, silver, and physical silver are now two separate markets with different incentives, different risks, and different drivers. Recognizing this split is the first step to staying ahead. Third, consider the strategic timing of future moves. The shift in exposure has effectively cleaned the books, removed leverage positions, and reduced immediate systemic risk. That might sound safe, but it also sets up the conditions for a rapid repricing event. Once industrial demand, sovereign buyers, or other strategic holders act on the physical scarcity, paper prices could adjust sharply in a very short time. Think of it like a spring that has been compressed and then partially released. The tension is still there, concentrated in new areas, waiting for the final trigger. Investors who anticipate this moment will be able to act ahead of the crowd. Those who don't will be chasing a rapidly moving market. Fourth, we have to address global flows. Asia is hoarding, consuming, and industrializing silver at a rate the West cannot match. Meanwhile, Western paper contracts are lighter, creating a mismatch in supply, demand, and pricing signals. The $42 billion move was a preemptive action by institutions, but it has also highlighted the growing strategic importance of physical silver outside traditional markets. The imbalance between physical and paper silver is not just a temporary blip, it is a structural trend. And history shows that structural trends of this nature, especially when coupled with physical scarcity, eventually assert themselves in dramatic price moves. Finally, let's look at what this means for investors and stackers. The $42 billion move has already removed weak hands and reduced leverage, creating a cleaner, more resilient market. Physical silver is concentrated in strong hands, industrial buyers, and strategic reserves, meaning future volatility will increasingly reflect real-world supply-demand dynamics rather than algorithmic forced liquidations. This is a rare opportunity for those holding physical silver. The market has been cleared, the weak hands are gone, and scarcity is real. Premiums and supply tightness are signals that the next major move may not just match Asia-AOS pricing, it could exceed it. But timing, patience, and understanding the disconnect between paper and physical silver will be critical. The next 90 days could define the trajectory of silver for years to come. In conclusion, the $42 billion off-book shift is more than a footnote in market history. It is a structural event, a turning point, and a warning all at once. Paper exposure has been reduced, leverage positions removed, and immediate systemic risk lowered, but the underlying physical market is tighter than ever, premiums are rising, and scarcity is building. Retail investors who understand this are in a rare position. They can watch calm prices on their screens while real-world dynamics point to opportunity. This is the story no headline will tell you. The market is quietly setting up for a major move, and the signals are clear if you know where to look. Those who ignore it may wake up when the gap between paper and physical silver snaps into alignment, and the market moves faster and farther than anyone expected. The lesson is simple but profound. The market is not always what it seems. The drama is happening behind the screens, in vaults, and across borders. The $42 billion off-book move has reshaped risk, revealed scarcity, and exposed the growing divergence between paper and physical silver. And now, the question for every investor watching this play unfold is the same. Will you wait for the headlines to catch up, or will you act while the real signals are still invisible to the crowd? The stage is set, the actors are in position, and the next act promises to be explosive.